Welcome to the Chaim Investment Advisors podcast. My name is Chaim Victor Schramm, and I'm here with Pablo Lasha.
Yeah, how's it going? I think we got a great topic today that we talked about a little bit last week. I know you and I, we think it's a great topic, so hopefully everyone else does. It's just one of those things that's like really interesting and really, I think, gives a lot of insight into things that people may not understand about how, macroeconomics works. So
Yes,
today, I think, yeah,
one of my favorite topics to think about, especially because I get asked a lot of questions. I always do, and every year I say, "Oh, this year I'm getting a lot of questions." It's always this way. People ask about yield, and they ask about the forecast of yield, and people always think, "Well, interest rates will go up, or they have to go up, or something like that." And oftentimes, I find myself coming back to this exact topic. So it's great to actually be um, getting into this topic in more depth than I ever have a chance to in that format, which is just like mention it and then get to other conversations. But a lot of the times, I think people do wonder, okay, why are these linked though? And that's what we're really going to get into is the link between demographics and interest rates.
right. And I think like you said, it's a really cool topic. One of the things that confuses people is like because economics is a complex subject. Sometimes we or other people may talk about how the Fed is influencing rates, what they intend to do, what they target, and it's important to understand in the short term you can do a lot, right? This is true
Yes.
for almost anything. In the short term, if I was the mayor of a city, I could do a lot to pressure people. I could say, look, we're putting in a curfew at 6, and I could say, no more laughing. I could do all sorts of things, but there's going to be a point where sort of the natural process takes place, just people's normal human behavior. It doesn't no longer matters what like Mayor Pablo says. It's now time to do
Yeah.
what the town people want. And so when we talk about demographics, that's really what we're talking about. I think it's one of the first topics we're going to discuss is just sort of the these numbers that we can only infer, right? But they're important numbers because they are like a sort of a convergence of everyone's opinion and ideas. Even if you don't know it, you have you have an input, not just some of it, you have like a considerable input along with everyone else on macroeconomics. And it's nothing to do with like in the end, these things are much more robust than people's policies because they last through countries, through centuries, and so on. So that's kind of like I think what
Yeah.
we're going to break down today. I think it's a really good topic.
Yeah. So what we should start with as a kind of definition so that people kind of all on the same page on this discussion is defining the natural interest rate because interest rates can mean a lot of things. I'm sure everybody listening to this thought of one thing first. Maybe
Yeah.
it was their mortgage. Maybe it was their bank accounts APY. Maybe it was their bond yields or
Yeah. Yeah.
whatever it is. But interest rate, you say that to a room full of people and everybody kind of self sorts into different things they're thinking about. So natural interest rate is something that we can actually talk about objectively, but kind of indirectly.
Yeah.
And so, natural interest rate, the definition of it is it's the real short-term rate that supports the economy operating at its potential output, so it's optimal function without increasing inflation. Uh,
Okay.
and that term real, that means adjusted for inflation already.
Right. Or like, yeah, exactly. In real, we can also say we talk about real GDP versus nominal GDP. So when we talk about real, it's sort of like we're talking about a concept that like this is where we baseline everything from, you know?
Yeah.
So when we talk about real in the natural rate sense, we're talking about this is the baseline. And everything after that is has to do with like maybe macroeconomic policies or certain factors that happen, or like, for instance, in this definition, we have like, what's the optimal, most efficient output, and obviously, there are a lot of things. We have like state actors and federal actors and businesses, and there's all these other things that can like really, really affect output. So what we're talking about is just like this sort of real concept of like, given if people were just, amongst themselves, where would they, where would they, it's sort of also like like I like to think of it as like a price in the market, right? Because it's a similar thing, where we all have different prices, but technically the market converges on a price. And if it's not being interfered with or monopolized, that's generally that price is real. But the difference is we have to infer this rate. We can usually see a
Yes.
price, we can't see this rate. There's too many other factors that are layered on top of it. And in fact, there's a lot of discussion among economists about like, where it should be or how we should infer it and things of that nature. But it's important to know it's there, because what we're saying is that
Yes.
all of us as a people, given if we were just, just going about our economic activity, we would have an idea, there would be an idea, a number that would like, we would converge on like, this is the rate that we think should be the interest rate. So I think that's like we want a really cool concept to introduce and start us off with, and also very important to this demographics conversation. So.
Yeah, and so yeah, that's an excellent point. That like I'm sure also the next thing people thought after I defined it, there was like, okay, Chaim, what is the natural interest rate? Which one of these various interest rates I engage with is that? Well, we don't know what it is
That's
directly.
right.
You get to observe it directly. It's not exactly like uh, it's there in the background, but it's not a number that's going to show up on any of your statements, so to speak. We need quantitative modeling to actually understand what it is, and that's a whole field of research. Is like, okay, how do we model what the natural interest rate at this exact moment is? Because it's super important to policymakers, and policymakers are absolutely referencing that on a continuous basis. So, they need to know what it is.
Yeah.
Yeah.
And I think even before we were ever even able to model it or have an idea how to model it, people might ask, well, how did economists know that this exists, right? And it comes back to this demographic situation, because
Yes.
you can do things in the short term, right, to pressure people, just like Mayor Pablo wants to pressure everyone to stay inside after 6, right? But the thing is, like, eventually, that's not going to last. And so, even if a government does something in its monetary policy, you can see through demographics consistent changes, and that's really one of the cool things I think that we'll get to discuss today. These consistent changes in demographics, which affect interest rates, which affect like growth, because all these things are tied together, right? So it's going to affect like how fast your country goes. A great example, I think we all have heard of like the phenomenon of China and China's growth. You're going to find that when you have those type of demographics, that you're going to have good growth under the right conditions. You would expect nothing less, really. It
Yeah.
would be difficult not to have that kind of growth, right? And so I think that's like a super important concept, even if we don't explain exactly like, hey, this is how you guys can figure out this rate. It's important to know that we're not just guessing that it's there. We know it's there because we can see across the data that like it pops up over and over. So,
Yes. And so there is an interaction between demographics and interest rates, and we know this. There's a ton of research on that topic, and when you say demographics, it's not just how many babies are being born. It's
right,
actually things like median age,
right,
uh, cohorts of age, what percent of the population is what
yeah,
age at any snapshot. That's actually says a lot about what's going to happen to interest rates. In America, the current trend is aging population, and that's true of pretty much the entire developed world at this point, is aging population.
that's
And
right.
that has very specific effects on interest rate.
Yeah, no, 100%. Like you said, in the developing world, we have birth rates which are not replacing the population. So
Yes.
um, 2 is the birth rate, right, that we like to see. I think maybe in some cases it might be a little bit like, I think like the number is usually close to 2. It should
Yeah.
be, because you have 2 people and they have 2 kids, and that replaces it, right? So I think that they just do some really, I'm not certain. I'm not like it's not like my field of study, but I'm pretty sure they just do simple math there. They're not like figuring out who's having kids and who's not. They're just saying, look, for every two people, you need a birth rate of two, right? So that's
Yeah.
pretty straightforward. But in a lot of places, it's less than two, and in some places, it's less than 1.5. And you probably people listening to this podcast have heard that. Like a lot of countries, for instance, Japan and like some countries in Europe, you have these declining birth rates. And like you said, we have these cohorts. So there's two problems with the declining birth rates, right? Or like two situations. We shouldn't say problems because everything is a trade-off in economics. One of the situations is if you have like any sort of like social policy that is based on the people working now paying for the people who are not working now, right?
Yes.
You do not want to have like an inverse pyramid. That's not a good situation for you because
Yeah.
that means that you have a lot of pressure on the people who are working now to pay for things for the people who are not working now. And you have other things like if the pyramid at the top is higher, you have these people spending more money. So it's not all like super straightforward. But the other thing, you're talking about interest rates and growth, right? When you have like this issue, it definitely interest rates are affected by how fast sort of the economy naturally wants to grow. This is regardless to like what the government or company wants to do. Like how fast do you need services? How fast do you need businesses? We've all been to towns where there's like the town used to be huge. It used to be like a city, and now it's not a city. Now it's just like a town full of like 300 people. And so you can see right there just sort of real world, if we can make this economics a little practical, you can see there a real world like how a demand is shifted when there's nobody there, right? I mean, now you have
Yes.
now you don't have nearly as many goods and services there, and that's going to affect this natural rate. So
Yeah. Actually, aging population, it's so interesting. So here's something that I'm really interested in with aging population, which is the idea that aging populations. So when your population, the median is drifted, so you're close to the average person, or a very large cohort of your population is retired or close to retired. That's the time when your population has the most investment capital, right? So people have saved a lot. They're at their peak saving at that time of their life.
right,
And so more investment means more capital. And
right,
more capital means you get closer to capital saturation, which means lower rates.
exactly.
Because the
Well,
demand for yield is more profound than there are people needing capital. There is more
100%.
demand for yielding than there is for assets needing that money to create the yield. And so you have yeah, people who are in people this term productive, all it means is that people are earning an income, not
Right, right.
not
It's not a qualitative statement. Right? It's just
yeah.
the term that like they use in demographics to describe. For instance, the younger cohort is like obviously being raised, and so at that time, really, they're taking up a lot of resources and costing some of the resources, right? So they're not like really producing anything. They're mostly just spending, everyone above them their money. So the money of
Yeah.
those people who are above them who are raising them. And what you say is a good point. Like I think we see this, right? We see a lot of capital in both this country and other countries looking for ways into new markets.
Yes.
And, again, like we don't make like a lot of like sort of ideological points of view on here, but like in my opinion, just like, someone who strongly believes in like free enterprise, it would be good actually for both the country that has that capital and the other countries if you have a flow of capital, because a lot of these countries do need capital, right? And a
Yes.
lot of them have, just there's a lot of hurdles and very exclusive and barriers, and capital is very exclusive, and you may not be in the right, you may not be in the right, like, socioeconomic status to find capital, right? And this is one of like the hurdles I think, that we've had with a lot of countries. Oftentimes, and I understand this also, a country wants to protect its ownership, right? It doesn't want someone else to come in and buy up everything. But that's
Yeah.
just like one structure of capital. There are many ways you could like, you could structure yourself so that like you don't have to give away equity, or you could share a little bit of equity and not a lot of it. You could do a lot of stuff where you're basically just like loaning money to people, right? And you could do, there's a lot of different ways you could do it. But the point is that like, this is like, as an example, this is like highlighted in the ways that, you and I talk about this all the time. Other places where people looking for margins, right? We're looking for alpha. We're like, hey, look at this developing country. What kind of like, things are there to invest there? Which is exciting, I think, for everyone. It should be exciting for everyone. Um, yeah.
Well, yeah, so. Yeah, a lot of the world doesn't have an aging population. They have the complete opposite. They have a really young
100%,
population. Uh,
yeah.
and so when you have a really young population, you have the opposite, where you have a lot of people who are productive, and that just means they're doing something. They're economically engaged. They're producing things. Uh, and those people need capitalization to expand what they're doing, to do it efficiently. And then, you have populations or countries are seeking capital, and
Right.
there's yields are high in that situation because there is more demand for capital than there is capital.
What?
And so,
Yeah.
yes, you get this really strong relationship between yields that is beyond the creditability of those countries. So, like, people often get confused, and they'll say, like, "Oh, Ghana is not a creditable country, and that's why it has high interest rates." And it's completely wrong. Ghana has a fraction of the leverage that America does. Like,
Yeah.
Ghana, through some lenses, is financially healthier than America's balance sheet. That's
Well,
just
and
how it is.
you're talking about, I think that's another, actually, is another good point where people talk about credit and credibility and risk. And like, I want to like preface this. I'm not saying anyone should never pay their debts. All right. But when we think about interest rates and risk, the risk of default is built into the interest rate. That's built into the market.
Yes.
So, it's sort of an interesting argument. I always hear people say this. The only time it's not built into the market is, to be honest, when there's some sort of government program and then it regulates the interest rate. I think we see that in student loans. One of the reasons that there's like this huge, sort of controversy sometimes is because the interest rate is artificially low. I think it should be like something like 15%, considering how many people they don't expect to ever pay back their loans. Which is really a mathematical problem. Again, this is not to be like talking about ideology or policies. It's just a math problem. We're just talking about what the math says. But you think about like someplace like you said, like these developing countries, not only is the interest rate high because they need capital, right? But I mean, there's more risk, but there should be higher yields when there is more risk. And in fact,
Yeah.
if you're an investor who's already satisfied, your sort of like income needs and sort of like the legacy that you want to leave, you're in fact looking for this sort of risk so that you can like make more money, right? And an excellent trade-off. You're going to make more money, and it's one of the best ways to lift people up out of poverty. And the other thing is, if Americans, are unwilling to invest in these places, like there are lots of other countries that are willing to invest in these countries, and
Yeah.
you basically just exclude yourself in that conversation. So,
Yes. Well, yeah, there's people I think are too used to only thinking about the creditability part, the likelihood that the person you've loaned money will pay you back. They're too
yeah,
used to weighting that very heavily.
right.
And that's not always why there is the interest rates that you see a lot of the developing world bearing. I think about the South African rand, which
Right.
is the currency of South Africa. The central bank of South Africa pays a very high yield for you to just in the foreign currency markets, just to own it, just to have the money,
Yeah, yeah,
for you to buy their currency. They pay on average, much higher, uh, like sometimes twice, three times what is normal for the developed world. And it's not because South Africa's central bank is not going to pay you. That's not what's the problem is. The problem is that South Africa needs capital. They need
yeah,
people who are interested in having the rand,
right.
and that's really drives all of that. Like the risk of, oh no, South Africa is not going to give me money when they control the rand and they
Right.
have a very large commodity backing base to back this currency. Not formally, it's not a gold or diamond backed currency, but there's definitely plenty of hard commodity money in South Africa. Um,
Yeah, I think
and so it's not the creditability that's mostly driving that. It's capital. They have a much younger population. They have a population that is trying to develop very fast. A lot of young people trying to develop very fast, and that's more why yields look like they do there.
yeah, I think like it's a good idea in general when you approach investing. If your idea is that this person is not going to pay me or this investment is going to collapse or whatever that is, just don't do it. If that's where you're coming from, I can guarantee you're going to make a lot more money just staying away from things that you think are going to fail. You don't look at it from the sense of like, well, it's a high yield, but it may fail. That's not like it's not really a good place. And in fact, you and I had this conversation. It's really where you have uh, where you have like a separation of your knowledge and the market's knowledge is really where you make money. So in fact, if I thought that something was definitely, it was going to be able to pay me and it was going to like make pass what the market thought or whatever, I would definitely invest in it because that's where I'm going to make all my money. It's like this people are going to pay 15% back and everyone's going to stay away from it because they think it's going to fail. But like you said, the demand really, it just goes back. I mean, I think like I almost think like it's everyone should have like sort of a simple, at least two simple like econ courses in high school because it really is enlightening about like how it works. But the supply and demand is a very robust concept, and it works very well, right? And so when you see high prices, like you see this high interest rate, it just means that like demand is high. Why demand is high? That's something that you have to articulate, right? Like you said, it could be demand is high because they actually just need the money. Or it could be demand is high because they'll never pay anyone back. I'm not saying for any currency. I'm just saying in general. But you have to look at like the set of facts, and demand being high is just the first set of facts, right? I mean, I give you a great example. You're talking about earlier. Is just like we have some shortages. Demand is high. The
Yeah.
price is high for these things that are in shortage. But why are they high? We have to like always like articulate and try to narrow down like what happened, what was the story there.
Yeah.
So yeah, 100%. I think that's true. And like yeah, like you say, these countries that are growing, this young core demographic that is like, that needs capital, you know what I'm saying? It's, to me, it's almost like, it's definitely like a moral prerogative that like, if you can help someone, you should. And if you can help someone and you can also be better off, I don't really see any reason why any sane person would not do that. You know what I'm
Yeah.
saying? So,
And so yeah, aging populations create um, people in search of a yielding asset because now they need yield. They're not productive economically in the same way. They need yield to keep living a lifestyle, and so they need the yielding asset. And a yielding asset is just a productive venture. That's all it is, a productive project or a venture that needs capital to exist and expand. And if there's fewer of those ventures because there aren't a lot of people working, and so labor force participation is also part of this conversation. Like that's part of demographic. Just having people is not the full picture because like if nobody wants to work, well, you could have all the people in the world. This part of the equation is not going to work. But so if you have strong participation in the labor force, uh, so but you don't have many people alive working who are young, who are doing ventures that need capital. You already have the preconditions for declining rates, and there's very little that could be economically engineered to stop that from happening in the long run of things.
right, right.
It all kind of uh, gets balanced along the way. And America has seen this actually, not just right now. Actually, so the CBRE, which is a commercial real estate group, did a really good model on natural rates in the US. And it really shows this model. It shows pretty convincingly that demographics drove the absolute collapse in interest rates in the 1980s. in 1984 was the peak of adults of the optimal working age. So between 40 to 54, the most productive people.
Yeah.
1984 is also the peak of interest rates. This is the highest interest rate that in
That's right.
modern America has ever happened. And sometimes people will attribute all of that really high interest rate that happened to political policies of Ronald Reagan, which is some of which was kind of a I don't know how to describe
There was
that.
definitely there was definitely a balancing out. Yeah, I think that like to talk about that, why like you said, there's multiple reasons the interest rate as follows. I don't even know if I necessarily just like say, Reagan. I guess it was also Reagan, but there was a balancing out because speaking of clever economists, at one point the economists discovered a correlation between inflation and unemployment, and they said, well, we know how to get rid of unemployment. We'll just increase inflation. And it turns out that was not true. That worked again. When we say this, it worked in the short term, but then eventually people were like, they have inflation expectations. This was what economists found out next, and they said, oh, well, now that they inspect inflation, they've gone back to not doing anything. At least the same amount of people who weren't working were now not working. But now you had another problem, which is that you had inflation. So you had the same problem you originally started with, but now you also have really high inflation. And so
Yeah,
like, and so what you're saying is totally true. Like this is a perfect example, actually, that of where, hey, the government thinks that they can like create this policy, and in the short term, the policy definitely works. But when you get out 6 months, a year, 2 years, I mean, by 2 years, the idea that like any policy is really going to be that effective, I'm very skeptical of that idea because people are just too adaptive. They just figure things out. And so you really, like you were saying, you have these demographics, and then you have too many things going on that like almost force like the interest rate to go up. And
yeah,
really, again, economics is trade-off, and so I think a lot of people suffered because of like just poor decision making and where it ended up. And we were already what would have been better, right? I think if the government had been transparent and we understood this demographic situation, it would have been better if they had just told people this is what we expect to see based on the data, and then people can like sort of cushion themselves for it. Whereas they did almost the opposite. They almost told them, "Well, don't worry about that at all." It's but like that was right. Like I was born in 1983, so it was like a couple years before people had to really suffer. So I just I guess I feel for those people. But yeah, that's a great example. Also, just a great little like a story of how economics is counterintuitive.
well, and it's funny because in hindsight, it's so glaringly obvious that this would happen because you have the
yeah.
baby boomers, the biggest demographic event to ever happen in American life,
Yeah.
all at the kind of peak productivity period of their life. Of course, interest rates were going to be the highest in American. It's just yes, of
Right.
course, it's that way. And so right now isn't even not right now is a good snapshot, but I think mid 80s really is all you need to look at to know, oh yeah, okay, this works. This is a pretty descriptive, way to think about interest rate modeling is like,
I
you
was
can't really refute that.
That's right. I was curious, so I just like wanted to find the U.S. birth rate, and so the first thing that popped up wasn't the birth rate. The first thing that pops up says that the U.S. birth rate has fallen by 4%, and last I checked, it was already too low to
Yeah.
sustain some of the policies, and also just to sustain the type of growth that you often see any politician promising. So I always find it's like it's really fascinating from like this economics/finance point of view when we're listening to politicians, oh, we're going to bring back growth and we're going to do this and that. And I'm always like, how? Like, what are you going to do? Because that's, to be honest, a little invasive if you're going to go into all those bedrooms and create a lot more babies, Like, I don't know what's going on here, man. Like, I don't really like your, but like totally, like, I don't know, like the rate didn't show up right off the bat, but I think last I checked is 0.7 or something like that. And
Yeah.
this brings up like good, interesting things where like, when we think about like, let's think about immigration. Cause like, if
Mm,
you are not going to
absolutely.
create new citizens, like they're not going to be born in your country, immigration is like really important. This is one of the reasons I personally think that so many European countries have taken on immigrants. I think that they know that this is a huge issue, and in fact, the issue would be
Yes,
even worse for them without immigrants. So like their thing is not like thinking about like even it's not even an altruistic thing. It's just like we need to have a population that like
absolutely.
is not inversed on the pyramid. Because again, we talk about kind of the cool things about it, right? Like aging cohort, maybe they're going to invest capital, and like that would be really ideal. But if you do have a policy like Social Security, it's going to be devastating if your birth rate is 1.7. That's
Yeah,
eventually going to come to a point where you're like, it's going to be a huge tax on those people who are working, who by the way are they're in this part of life where they are like being quote unquote productive. So they're not like in the luxury part of life, right?
yeah.
It's not the part where you really want to be like depressing anyone or taxing anyone into
Yeah.
misery. That's really the part where they're just trying to get through to where they can retire. So
Actually, that's a great segue to another part of the demand question with interest rates and demographics is like think about who needs credit the most.
right.
So we talked about businesses and ventures, and
Yeah.
that's like a huge part of the capital and yield conversation. But also there's a there's family finance, the family balance sheet side of things too.
Yeah.
Absolutely applies in this case. So think about like who needs credit. Uh, who really is demanding the credit? Well, it's people who need to buy a house, number one.
Exactly. Yeah.
People who need to go to college. Number
Yep.
two, people who need to buy their first car or a new mid-career car. Those are people who actually like
And
need credit, and that's where the demand uh, is highest because they have the cash flow to take on credit. Like young students, you're 19 and you'd love to buy a condo, but it's not.
oh yeah, you're right. And like,
Uh,
I think also like along with that is that like you can see that shift in like how people save through generations, and sometimes I think people do attribute it like to culture, or they'll say like, well, this generation just saved more. But really a lot of it is just like how much credit's available. Like if you have a lot of credit available, the idea of like, oh well, should I save money or should I, if I am getting a rate of like 5 or 6%, why don't I just take out a loan? You know what I'm saying? Especially
yeah.
when you're young. This is when you want to, you're making these decisions when you're young. You're like, I have a whole lifetime of cash flows ahead of me.
Yeah.
Why should I not maximize my capital right now? I should just take on more, as much capital as I can, right?
Yeah.
And again, we can all like, we're not here really to tell you guys this is good or this is bad. It just depends on your situation and your prerogatives and what you're looking for, right? I mean, if you're happy at the end of the day, this is good. If you're like, man, I feel depressed and not like all in chain, it's not a good thing. But we're not like discussing necessarily the qualitative statements about this. We're just talking about like how this affects people and how,
Yeah.
especially this is important because again, I'm not like against all politicians, but I think politicians oftentimes just get up and they make these sort of promises or they say these things, which if people knew more about economics, they would know that this is not only something they can affect, it's just laughable that they would even
Yeah.
even bring it up. It's just like, okay, like you're gonna do what now? Like, okay.
Yeah.
So yeah.
That's, in this conversation, no, there's not, politicians can't just wave a million, 10 million to people into
Yeah, that's
existence.
right.
That's just not a thing.
Yeah.
Demand for
Yeah.
credit. No, the politicians can't do all that much. Like they can marginally uh, change that, but not that much because the people have to be there in the first place to change the policies
And
around.
they're changing something short term, right? I mean, they're not like
Yes,
making long term changes.
they're smoothing,
And
they're normalizing is what they're
exactly.
doing,
Yeah, yeah,
which
totally.
is that's their job, but it's also it's not most of what's happening. Most of what's happening is people being born, growing up, and eventually dying. That's
I think
that's
like
really what the economy actually is.
we might do maybe it's probably been talked about a lot other places, but maybe like next podcast we can do a little conversation on the supply shock that we recently experienced because it kind of relates to this.
Yeah.
And you can see how, yes, the government can definitely affect. We're not saying like no one in their right mind would ever tell you that like a government could not affect the economy, right?
No, no,
But you will
obviously.
also see that the things that are happening right now are a result of having to pay the price for those things in the future, right? I mean, that's what you see. It's the same thing with the credit situation, right? When we are taking on a lot of credit, there's going to be an effect in the future. People are going to want their money usually. This according to like the mails I get, but people want like to get paid, And so I think that like oftentimes, too oftentimes, it's like looked at as like, this is good as this is bad. And really, if you really want to be like sort of financially and economic literate, you got to start thinking of things in terms of trade-offs, right? I mean, we talked about this in the fixed income, uh, like defined income podcast, right? We're talking about like you can use different types of annuities for trade-offs. And this is really, in my opinion, this is one of the key concepts for economics or for finance is like not looking at like, oh, this is good or bad. This is like, what is the trade-off here? What am I
Yeah.
risking and what am I getting? Where is the risk being transferred? So
Yeah. And so yeah, aging populations with this stuff, I mean, it's pretty intuitive in a lot of ways. So yeah, if you've got all these older people looking to capitalize, they want to put their money to work to yield. But they need to go out there and find people who want to borrow money because that's what yield is people who mostly want to take your money and make more money and then give you some
that's right. Yeah,
on a
generally how it
consistent.
goes.
That's
Otherwise,
fun.
it's called charity.
Well, and actually, that's another kind of from what I've noticed and what's going on right now. That's actually a good segue because okay, so there's people out there they're trying to give their money to people who want to use it and be productive, but there's a lot more people looking to make yield than there are people who need capital. Because there's just not as many people who are borrowing. And our generation, the millennials, also aren't doing a lot of the things at the same rate that
That's right.
cause the need for credit impulse, the demand for credit. So they're not really buying houses at the same rate. They're not really having kids at the same rate
Yeah, it's in
at
fact
all.
it's pushed back to like a considerable amount. The amount of like I just said that we saw that like the birth rate is dropping. Not only is the birth rate dropping though, but the age at which people want to have families is being pushed back. The demographics of those people who do want to buy houses is different than it used to be,
Yeah.
and it's for different reasons. And so you really, you know, yeah, we probably could do like 5 podcasts on this, to be honest, because there are so many complexities. One of the things that we were talking about sort of like last week, just amongst ourselves when we want to talk about this topic is just like, the demographics in China and what we think will happen, because
Yeah.
imagine a situation here where we do have an aging population, but we don't have the same amount of capital available as we do in a society structured like America, where really what you have here is a situation where there's many people who rely on pensions and they're aging. And so if you're Chinese policymaker, you are faced with an entirely different set of problems. You've just
Oh
gone through
yeah.
some of like the fastest amount of growth you ever experienced, and there's probably a lot of pressure. No one ever likes to see you. Your bosses want to see you come in and have lower numbers than last year, but you're really facing a situation where it's like, well, how am I going to get higher numbers? I do not have the same rate of like productive workers, and I actually need money. So
Yeah.
yeah. So yeah, this is why we find this topic so fascinating, because I think there's 2 things I found that like I always thought was surprising when I was studying economics and finance, and that's the effect of demographics and the effect of geography, which is much more than people think it is. And oftentimes
Yeah.
people attribute things to ideology and they attribute things to culture. And a lot of these things, a lot of people's behaviors, much more than I think people think, can just be attributed to demographics and geography. Much more than like I think that people will be surprised that like you change the ratio of the population, you change where they're at, and different things entirely happen than they're happening now. So
Yeah, and so you get really interesting things in personal finance, like where I see this, kind of trickling down to is like, think about this. Have you ever had like a friend or family member, like somebody that that said, I figured I might as well lend money to my kid or to my nephew or a friend of my
yeah,
son than
yeah,
leave it in a bank or bonds with yields being so low. Well,
yeah.
that is one of just the most on the face of it examples. Like this is somebody who like it they feel like it almost costs them money to have the capital sitting around. And so they
Right.
will literally give it away to find somebody who's going to do something interesting with it,
That's right. Yeah.
and pay them a very small or maybe deferred rate.
Yeah.
And so like going into entirely like gray markets for yield,
Right. Totally.
that are like, beyond speculative, because nobody's even bothered to get a credit rating or anything. This is just like I have seen
Well,
this happen at a faster and faster rate. And it's interesting to me because I see it as like that is a symptom of precisely this phenomenon. This is
no, I
exactly
agree.
what this is. This is what it looks like when that happens. So it's interesting to know the big macro economics explanation for why those kinds of behaviors are showing up.
Like, yeah, that's a great point. I think like I don't know, like really, like I said, I think you and I probably talk about like demographics all along because there's like there's a lot of things going on, and there's a lot of things where you can tell what's going to happen based on demographics. I mean, even if we just look at why is there not as many places to invest your capital? As a society grows and becomes more comfortable, and that population wants to be more safe, they usually they don't want to themselves have a lot of risk around them. If you're older and you want like yield, you're like, yes, those things require risk, but you don't want the risk anywhere near you or your family, or So really, it's places that are growing where people want to take a lot of risk, and that's the places where you sort of have like this more wild, wild west like type of thing going on, and that's just a part of like I think the cycle of the world and like the cycle of economies.
Yeah, one thing that I've been interested in with this conversation is like, um, often cited fact about yield is that the highest yielding corporation in history was the Dutch East India Corporation. And to my knowledge, perhaps there was somebody else that yielded higher, but sustained. The
Yeah.
longest, highest sustained yield was 22%. That was the dividend yield being a partner of the Dutch East India Company. And the entire existence of the Dutch East India Company happens to just line up with the explosion in population from the Industrial Revolution. It just like happens to be that and be bookended. The Dutch East India Company ends with World War II, which was an immense demographic catastrophe in its own right around the world. So it's really interesting that the often cited fact about yields, oh, Dutch East India, well, it's not really a coincidence either. That's also this phenomenon in action where you have, yeah, every single generation from the beginning of that company's existence to World War II was exploding in population around the world.
And like really, your yields and your growth are only going to come from one or two things. It's going to come from more people, or it's going to come from innovation and technology. But your innovation and technology is also just going to come from more people. Every time you have more people, you have more chances that someone's going to be Einstein, or someone's going to be like Hayek, or someone's going
Yes.
to be like someone who has these insights. It's like that is Steve Jobs or whatever it is who's going to innovate. And so ultimately, it does come as no surprise that if you have more people, then you are going to have more growth because they're both going to be more productive and you're going to have more opportunities, more actual individuals who
Yes.
who are on some sort of like extreme or standard deviation from the mean of intelligence, right? So they're just like off the wall smart, you know what I'm saying?
Yeah.
Off the wall creative. I think like I always think of like this one thing. It's like sometimes people like ask like why are why is the U.S. so dominant in sports? I think that like the Pac-12, if it was a country, would be ranked at like something like in the top 10 of countries in gold medals in the world or something like that. And that's like pretty impressive, right? I mean, it's just like, well, you guys, or the Pac-12 rather. The Pac-12 is just the conference encompasses the 12 schools up and down the West Coast. But the thing is, the reason this is true is because we have like 300 plus million people. You know,
Yeah.
it's just going to be very difficult if your country only has 2 million people for you to produce as many genetic anomalies as we
Really?
produce. And it's the same thing for like just creativity or intelligence or anything, any of these parts that contribute to growth. So
Well, yeah, that's one of the most fascinating things to me about emerging markets, which is kind of maybe a good place to leave off and have another
a new
entire
podcast about, I
spiel
agree.
about that
Yeah.
because uh, this is really interesting to me as emerging markets. The presumption years ago when I started as an advisor, I never believed this to be true, but the prevailing wisdom was, oh, well, emerging markets mostly just mine commodities or grow stuff and send it to the developed world. And they don't have their own innovation and they're not, there's a brain drain and they don't have their own native companies. And it's completely been wrong.
Yeah.
That has completely been wrong. If you look at MSCI's index of emerging market companies, the cap weighted index,
Yeah.
it's massively weighted towards technology. And what's going on there is exactly what you're saying. Seafarer Capital, they recently had a little presentation to advisors where they were talking about, for continuing education. Uh, they were talking about this fact that in reality, technology is what's driving emerging markets largely right now, is because look, you have so many people in the emerging markets compared to the developed world. You compare a country like Nigeria to Denmark. Okay, well, I'm afraid that Nigeria is going to have astronomically more geniuses than Denmark will. Um,
Yeah.
I mean,
Yeah, that's
it's like,
totally. I think it's a great point. And like you say, I think it ties in well. But I think we should do a podcast on that. That would be great. Um, so we promise you 2 podcasts. We'll bring you one. We promise at least one. But we'll do. But like I think that like brings up a great point is what we were talking about earlier. The places for capital to flow. It's sort of a very eloquent solution, right? Because we have these places for capital flow, and they need capital, and there are in these emerging markets where there's, they have the people, the human resource, they have the human capital. They need the other type of capital. So I think that's an awesome point to
yeah, and it's people who are inventing things faster than in the developed world sometimes, and people don't always know that. That like, I noticed this when I was in China, there was new technology that was completely new to me.
yeah.
That I was like, whoa, this is just a widely available thing. Really crazy how much really cool technology is being developed in the emerging world. Uh, and a lot of that really is right down to demographics. And absolutely, yield is part of that. Just how many productive people who are like at the peak, cognitive peak as well. That's right now in the developing world. That's what's happening.
It's great. Yeah. No, I think it's great. I mean, hopefully, like when listen to sparks like an idea or a conversation. You guys feel free to send us questions. Um,
Yeah,
I think like we definitely will do like an emerging markets. I think that's actually been on our radar. And then
yeah,
maybe continuing like a little bit talk about the supply shock. I think that'd be just a nice way to sort of round out like a little bit about our economic series. We
yeah.
talked about a lot of different concepts. So yeah, this has been awesome. I really appreciate this exciting conversation.
Yeah,
I
no,
look forward to doing more of
this
these.
is one of my favorite. Actually, I think every time we do a macro one, I say, yeah, this is my favorite one. Which yeah, I really actually enjoy talking about macro. Which so it's fun to do it because so often in client conversations, we get just these kind. We have so much to cover implementing these ideas, and a lot of times they're totally new ideas. It's like every idea is a new idea in some of those conversations. And we don't actually get to get in depth into the macro side of things because we're just talking about how do funds function, what's in a fund, what are some of the philosophies driving allocation. But like this stuff is not stuff we actually get really in depth into, like why is it true. uh,
Yeah.
and it's fun to talk about because it's once you start digging into, okay, well, why are things happening this way, is much more intuitive than you might guess. That
Yeah.
yeah, demographics, inflate or interest rates are inextricably linked.
I think also we might do a sort of Q&A session
Yeah,
at some point. So we're like sort of considering that, like maybe we're going to do like a little shorter podcast format, but do a Q&A session so people can ask us questions or talk about just like general topics. Because
yeah.
usually when we do these podcasts, to be honest, we talk about news topics for like 30 minutes beforehand.
Yeah.
And it's a lot of interesting stuff that we talk about that we don't ever discuss
I know.
in the podcast, but I think it's things that people would like to hear about. And some of it's just funny. Some of it's just like general like finance or economic stuff that we find to be hilarious. But sometimes we talk about like something like really cool, and a lot of these topics, like yeah, I think like someone once asked you to like redo like any sort of like rehearsal. It's like no, because we've discussed a lot of this stuff
Yeah,
prior, and when these like sort of 30-minute sessions do beforehand, we have very like a raw conversation. So maybe at some point we'll do a podcast where we do some Q&A and like folks want to ask
I
questions.
like that. Yeah, that's one of my favorite formats is the um, Q&A type of format, actually.
But
Because yeah,
before COVID, we did we used to go do those in person. So that was really fun. Actually, we did enjoy that. We liked
yeah,
going out to
man.
like any sort of Portland color event or like going to an asset resistance event. We were like go and just in person. People would have questions that they don't think they're like maybe embarrassed or maybe they just didn't learn or whatever it is. Like hey, I don't know this. And what does this mean? And why do I always see this on TV? And it's really fun to talk about those things. So we're open if
Yeah.
you also if you just want to send us questions. We're fine with that too.
Yeah, they people do, and then they filter into to these conversations because yeah, I feel like I'm just always collecting, like, okay, what are people really talking about, thinking about, asking about?
Yeah.
Always good fodder for this. But the macro series is cool because it's a
It's one
little
of my
separate.
favorites
That's
too. Yeah,
that's
it is.
that's
Yeah,
kind of like what we are always talking about.
it's true.
And so it's cool to get to do some of that in podcast
It is.
form.
It's one of the, like economics just in general. We haven't really discussed anything besides macroeconomics, but there are a lot of cool things in economics that are just things that people can pick up and learn a lot about like the world around them. So we are getting much better. I think we're doing like one a week almost consistently
Yeah,
now. So we're gonna probably continue to try to do that. And just like if you have any questions, just definitely let us know.
excellent. Well, this has been a lot of fun, and I hope you guys enjoyed it, and hope it, yeah, sparked a lot of conversations. I'm sure it will. And looking forward to doing the next episode uh, next week. And
Yeah.
yeah, this has been me, Chaim, and here with Pablo
Yep. We'll talk to you next week.
next time.